Take a look at this timeline chart. On the left, a crypto asset hitting a glowing peak of $84. On the right, that same asset flatlining at less than 35 cents, slapped with an estate bankruptcy warning. The architect behind that massive drop was once considered a titan of the crypto industry. His exchange collapsed overnight in November 2022, resulting in one of the largest financial fraud trials the space has ever seen. And while he now sits behind high concrete walls serving a 25-year sentence, the token he created, FTT, is surprisingly still actively trading. When you see a historical chart with a plunge of that magnitude, it is tempting to wonder if you are looking at the ultimate buy-the-dip opportunity. But applying traditional value investing logic to a 99% discount becomes a dangerous trap when the asset itself has completely detached from reality. To understand why, we have to look at what FTT actually is. Technically, it is an ERC20 token running on the Ethereum network. When it launched in 2019, its main job was straightforward, giving users discounts on trading fees inside the FTX platform. Traders also used it as collateral to back up their high-risk, leveraged positions. At its peak, FTX was the third largest crypto exchange on the planet, which meant millions of active users were buying FTT to get those perks. Then came the massive bank run. In a matter of days, that giant exchange fractured and collapsed entirely. Because FTT was built exclusively to operate within an ecosystem that is now dead, it currently solves no problem, offers no fee discounts, and holds zero organic utility. Let's look at the actual math keeping the token afloat. Right now, there are about 329 million FTT in circulation, out of a maximum cap of 352 million. Originally, FTX operated a buy and burn mechanism. They used platform profits to buy FTT off the open market and destroy it, artificially reducing supply to drive up the value. This tokenomics scorecard compares the original setup against today. The buy and burn row goes from active straight to completely dead. But the most severe risk is the FTX bankruptcy estate. It controls a massive stockpile of discarded FTT, entirely dwarfing the token's $100 million market cap. Legally, the bankruptcy managers have the authority to liquidate those remaining tokens onto the open market whenever they choose. In crypto, exit liquidity is the term used when early holders or massive entities need a surge of new buyers to absorb their sell-off without crashing the price. Buying this token today means you are volunteering your capital to serve as that exact exit liquidity, effectively paying the estate's bankruptcy lawyers out of your own pocket. If you try to read this candlestick chart using traditional technical analysis, you won't find any logical patterns or reliable support levels. The real driver for every single price movement on FTT right now happens entirely on a device like this. When news breaks that the FTX Recovery Trust is repaying creditors above 100%, social media rumor mills spin up and create sudden waves of speculative buying pressure. Even more bizarre, we've seen the token pump based entirely on sporadic tweets sent by its imprisoned founder. These are substantial market moves. A single headline can trigger unpredictable spikes of 50. You are buying with the explicit hope that someone else will pay even more for it based on a rumor, before the inevitable crash. If you are a beginner looking to park money in an asset with long-term growth and actual utility, the math here is brutally clear. Without an active platform backing it up, and with a massive estate sell wall ready to drop at any moment, the risk of total loss is nearly certain. The only profile that might extract value here is the high-risk momentum trader, the degen who actively hunts out extreme volatility regardless of what the underlying asset actually does. To capture those speculative spikes, you have to monitor social feeds and crypto news constantly, timing your exits perfectly before the rest of the market realizes there is nothing propping the price up. This risk-reward quadrant maps out the exact problem. Technically, you can make money on these spikes, but the extreme effort required to manage that zero fundamental volatility makes it a terrible environment for standard investing. Our decision matrix leaves us with a stark conclusion. For 99% of the market, FTT is an absolute avoid. The ecosystem that gave it value is entirely gone, and the massive bankruptcy stockpile poses a looming threat to any remaining liquidity. If you fully accept you are engaging in high-speed momentum gambling rather than investing, you can find FTT on Binance, trade it on OKX, or swap it on Uniswap. If you found this helpful, smash that like button, subscribe for daily crypto breakdowns, and share this with someone who needs to see it. Drop your thoughts in the comments. Are you bullish or bearish on this one?